Requirements for record keeping and documentation under the UAE Corporate Tax Law. One of the foundational principles of an efficient and transparent tax regime is ensuring that taxable persons maintain comprehensive and accurate records that can support the information provided in tax filings. Under the UAE Corporate Tax Law, it is mandatory for businesses and entities subject to tax to keep detailed documentation that can substantiate the data included in their tax returns or other documents submitted to the Federal Tax Authority, FTA. This record-keeping requirement ensures that the FTA can readily verify the taxable income of a taxable person, making tax assessment and compliance more straightforward and transparent. The law emphasizes the importance of maintaining proper documentation, not only to support the tax return itself but also to facilitate the FTA's ability to ascertain the taxable income of the business. This process allows for greater accountability and reduces the likelihood of errors or discrepancies in tax assessments. Key record-keeping obligations. As per the Corporate Tax Law, taxable persons must maintain records and documentation that serve the following purposes. 1. Supporting tax return information. All records should support the information provided in the tax return or in any other documents submitted to the FTA. This ensures that the information reported is accurate and can be cross-checked against the supporting records. 2. Enabling the determination of taxable income. The records must allow the FTA to readily ascertain the taxable income of the taxable person for a specific tax period. These records form the basis on which tax assessments are made. To ensure compliance, taxable persons must keep these records for a period of time, as specified in the Tax Procedures Law, which governs the procedural aspects of tax compliance, including record retention requirements. Types of records and documentation to be maintained. While the Corporate Tax Law does not specify an exhaustive list of records that must be kept, it does make clear that businesses are required to maintain documentation that is relevant to their specific activities and the complexity of their operations. This is because the nature of the records needed will vary depending on the type of business, the size of the operations, and the specific tax requirements applicable. However, there are common categories of records that generally need to be maintained by taxable persons, including but not limited to the following. 1. Transaction records. A comprehensive record of all transactions that take place during the tax period. This includes sales, purchases, and other income-generating activities. Proper documentation should be kept to substantiate these transactions. 2. Asset records. Detailed records of the taxable person's assets, including any purchases, disposals, or changes in the asset base during the tax period. This would cover physical assets such as property and equipment, as well as intangible assets like intellectual property or goodwill. 3. Liability records. Documentation that reflects any liabilities incurred during the tax period, such as outstanding loans, unpaid debts, or other obligations the business is required to fulfill. 4. Stock records. A record of inventory or stock on hand at the end of the tax period. This includes details on the quantity and value of any goods or materials held by the business. Examples of specific documents. In addition to the broad categories listed above, businesses may be required to maintain specific documents that provide evidence of transactions and financial activity. Some common examples include bank statements. These documents reflect the cash flow of the business and can be used to validate income and expenditure reports. Loan or financing documentation. Any documents related to loans, leases, or other forms of financing the business has undertaken. Sale and purchase ledgers. These ledgers detail the business's sales and purchases and can support income and expense claims. Invoices or daily earnings records. These may include receipts, invoices, or till roles that document daily income from sales or services rendered. Order records and delivery notes. These documents track orders placed and delivered, providing evidence of sales and inventory movement. Other relevant business correspondence. Any other documents that are part of the business's ongoing operations and financial dealings, such as contracts, agreements, or tax-related correspondence. Format and retention of documents. There is no explicit requirement for these records to be kept in their original format. This offers businesses some flexibility in how they store their records. For instance, paper documents, such as receipts or invoices, can be scanned and stored electronically, provided the digital copies are clear, legible, and accessible. This is particularly useful for businesses seeking to minimize physical storage space while maintaining a robust digital archive of financial records. Regardless of the format, it is important that these records are easily retrievable and in a form that can be reviewed and verified by the FTA upon request. Consequences of non-compliance. Failure to maintain the required records can result in significant penalties under both the Tax Procedures Law and the Corporate Tax Law. The penalties for non-compliance are as follows. AED 10,000 for each violation of the record-keeping requirement. AED 20,000 for each repeated violation within 24 months from the date of the last violation. These penalties are designed to encourage businesses to comply with the record-keeping obligations and ensure that they are able to provide the necessary documentation in the event of an audit or request for review by the FTA. For more details, contact us.